You've heard the chatter, the doom and gloom from the bears. But what if I told you they've got it all wrong? Today, we're diving deep into the bullish case for the market, exploring why the economy might just be stronger than you think. Stick around, because we're about to bust some myths and reveal some truths that could change your investment strategy. All right, let's get into the meat of it. Picture this. You're at a game and everyone's betting on the underdog, the bears. They're all about the end of the world, the crash of the market, but what if they're looking at the wrong playbook? First off, let's talk about interest rates. Now, you might have heard that higher rates mean a weaker economy. But here's the thing. Rates aren't just about borrowing. They're about saving too. When rates go up, sure, borrowing gets more expensive, but saving becomes more attractive. More savings can lead to more investment in stocks, especially when those savings are looking for better returns than the paltry interest banks offer. Now, let's debunk this myth that a higher rate environment is automatically bad for stocks. Think about it like this. If you've got a business and suddenly your costs to borrow go up, you might start looking for ways to cut costs, right? Well, companies do the same. They get lean, mean, and efficient. Plus, with higher rates, the quality companies, the ones with strong fundamentals, they shine even brighter because they can handle the pressure. They're not just surviving, they're thriving. And here's another kicker. Inflation. Now, inflation's like the boogeyman for many investors, but let's flip the script. Moderate inflation can actually be a sign of a healthy, growing economy. It means people are spending, businesses are investing, and the cycle of economic growth is in motion. Remember, inflation doesn't just mean your dollar buys less. It also means businesses can raise prices, which can lead to higher profits if they manage their costs well. Let's dive deeper into the consumer sentiment. You've heard the pessimism, but here's what's not on the front page. Consumer spending is still robust. People are still buying homes, cars, and yes, even those avocado toasts. When consumers feel good about their future, they spend, and spending drives the economy. But what about the bear's favorite argument? Corporate earnings. Here's where it gets interesting. Earnings haven't tanked like the bears predicted. In fact, many sectors are reporting better than expected earnings. Why? Because companies have adapted. They've adjusted their supply chains, found new markets, and are now positioned to not just survive, but to capitalize on these changes. Now, let's address the elephant in the room, the Fed. The bears love to point at the Fed's actions as a sign of an impending doom. But let's be real here. The Fed's moves are more about steering than stopping the economy. They're like the captain of a ship, making adjustments to keep it on course, not to sink it. So, if all this sounds so rosy, why are there still bears out there? Well, fear sells. It's easy to get caught up in the negativity, especially when you see headlines screaming about a potential crash. But here's the real challenge: separating the noise from the signal. How do we do that? By looking at the data, not the drama. For instance, let's talk about employment. Unemployment is low, and wages are starting to rise. That's not a sign of an economy about to tank. It's a sign of an economy that's on the mend. And when people are working, they're spending, which keeps the economic engine running. But what about the stock market itself? Here's a fun fact. Historically, the market tends to go up over time. Sure, there are bumps, there are dips, but the general trend is upward. And why? Because innovation doesn't stop. Companies grow, and new markets emerge. So here's the key. Understanding that while there are always risks in the market, the data suggests that the current economic climate might not be as dire as the bears make it out to be. The real opportunity lies in recognizing that while the bears are focusing on the immediate, the bulls are betting on the future. In summary, the bears might be wrong. The economy has shown resilience, consumers are still spending, companies are adapting, and the Fed is navigating, not dooming. Yes, there are challenges, but with every challenge comes opportunity. Now, if you're ready to dive into the bullish side of the market, hit that subscribe button for more insights like this.